Hello and welcome to AAT Xtra. This episode is to support you with the professional synoptic assessment, specifically focusing on the budgeting. If you haven't watched AAT Xtra before, this series is designed to motivate and support you with your studies, as well as provide you with information on how being a member of AAT can help to shape your career. Today we're joined by Peak Accountancy Training, who will shortly be going through a great learning session on how you can best tackle the budgeting parts of the professional synoptic assessment. After that, I'll be back to talk to you about what AAT can offer you and your career after you've completed your professional diploma in accounting, so don't go anywhere. If you can't watch this episode right now, don't worry. You can watch the video at any time after the stream. Also, be sure to watch the 3 episodes we shared previously. Just go to facebook.com/youraat/videos. Before we join Peak Accountancy Training, here are a few updates from AAT. For those of you preparing to sit your foundation or advanced synoptic assessments, the next window to sit them both starts next week, between the 2nd and the 8th of March. Results for this window will be available on the 16th of April. The next professional synoptic assessment window is between the 9th and the 15th of March. Results will be available on the 23rd of April. Please remember, results for the synoptic assessments will be available throughout their respective release dates. There are no set times for results to be released, so keep an eye on your AAT dashboard for yours. Next, let me introduce you to AAT Future Finance 2020, an exciting new learning experience designed to give accountants and finance professionals the skills and knowledge to adapt and grow their careers. AAT Future Finance takes place on the 18th to the 19th of June in Birmingham, and will bring together some of the brightest minds in accounting and finance to share practical insights and actionable advice on the latest industry trends. There's over 30 sessions to choose from across 2 days, and you can attend for 1 day or 2 depending on what you want to learn. Some of the highlights on Thursday include the latest tax updates, workshops on how to improve your leadership skills, sessions covering strategic management accounting and the latest tech news. And on Friday, there's technical updates, how to develop your advisory skills. You can learn more about finance business partnering and how to support business growth. You can find out more about AAT Future Finance 2020 at aat.org.uk/futurefinance. Now it's time to join Peak Accountancy Training for their study support session on PDSY budgeting. And I'll be back later to talk about MAT status.
Good afternoon. My name's Clive Pauling. I am one of the owners of Peak Accountancy Training. We are based up in the northwest near Macclesfield with training centres in Chester and Liverpool. But we also offer a full range of AAT courses on an online basis. But enough about me. We are here this afternoon to talk about task 2 of the Level 4 Synoptic exam, a tricky task essentially based on the budgeting syllabus. But what should you know? That's what I'm here to help you with this afternoon. Of course, from the budgeting exam itself, you should know all about how to calculate budgets, how to crunch those numbers. But also there's quite a bit of theory behind budgets, understanding what the purpose of budgets is, the motivational effects for the staff when a budget is introduced. And that essentially is more likely what the task is going to be about. Sure, there might be a few numbers in there, but it's about your ability to be able to dissect a budget, say whether you think it's actually serving a useful purpose for the business. So much is made of writing techniques, and that is important. But of course, unless you've got something to say, then you're not going to get the marks. So let's shed some light on the knowledge that you should have entering your exam. Wow, that's quite a lot of bubbles, isn't it? But this is all the theory behind budget. So I'm just going to pick the first one there. There's a word there, prime. I don't know whether any of you have come across this before. It's a useful mnemonic. A mnemonic that allows us to consider what a budget actually gives a business. So let's go through the letters then. What's the P stand for, do you think? A plan. Planning. Budgets allow businesses to plan for the future, to work out what they think the demand is going to be from their customers, and from that, be able to work out the resources they're going to need and the underlying costs of those resources. Plans, well, they can extend a long time out into the future. But if we're talking about operational budgets, typically we're talking about the next 12 months. But of course, large businesses, such as our business in the pre-scene, is going to be a limited company or a PLC. And those businesses have to plan even further into the future, particularly with big ticket items like capital expenditure, for example. So, planning. All businesses need to plan. What about the R then? R stands for responsibility, and a budget allows a business to make managers responsible and accountable for basically looking after the resources in their particular area. So we can give a budget to a departmental manager. That budget has been pre-approved by the board of directors, so they know they can run their area of the business within the confines of that budget. I, integration. What does that mean? Well, the budget process, putting a budget together, helps the business to integrate its activities. As part of the budget process, ideally, managers will be given a bit of a steer from the top. Objectives cascade down the organisation, helping the managers to understand what is going to be required of them, what the business is setting out to achieve. So they all go away, they develop their budgets, which are going to give them the resources they need to operate in the next period. That is then all brought back together, typically by our management accounts department. And they can make sure that the whole thing adds up, that all the areas of the business are pulling together, goal congruence, if you like. And that pulling together will help the business to achieve its objectives. We don't want departmental managers playing political games with our budget. We don't want them putting in for more resources than they actually need, because what's that going to do? It's going to deprive another area of the resources that they desperately need just to do their job. So the budget has got to make sense. It's got to coordinate all the different areas of the business. M, motivation. Now, there's a word that a lot of people maybe don't consider when they're thinking about budgets, because they see budgets as just being restrictive tools of management, stopping them from spending the money that they want to spend. But if set correctly, a budget should motivate the junior managers, motivate the workforce to stretch themselves, to improve performance, be more efficient, reduce costs, while still meeting the quality that is required to satisfy those customers. Set it wrong, and motivation goes pear-shaped. Managers and staff will be demotivated, and the budget will be pointless. And finally then E, evaluation. You've got a plan, well, let's evaluate our performance against it. And by calculating those variances, of which you did many calculations as part of your decision and control syllabus, and also a few in the budgeting syllabus as well, we can pinpoint areas of concern, and we can understand what's going wrong, and management can decide whether to take corrective action. Of course, variances could also go the other way. They could be favourable, but equally we need to understand, therefore, what we're doing right, because we want to replicate that action in the future. So there's our word prime, a useful memory aid helping us to understand what a budget is actually used for. So let's pick another couple of those bubbles around my enlightening light bulb. Fixed budgets and flex budgets. What's that all about? Well, a fixed budget is the budget produced on a certain set of assumptions at a certain point in time. So when a business is putting their budget together, they need to take assumptions about what the next period will be like, and they will build their budget around that. But of course, when it comes to evaluation, when we're actually operating in that budget period, well, assumptions may be different. For example, we may be operating at a different volume to the one that we set out for in the budget itself. So we might want to flex the budget to give us more meaningful management information. So what does flexing the budget mean? Well, we know the actual activity level we've performed at. So let's use our original budget assumptions, but against the actual volume of activity and restate the budget. That's what we're doing. We can then compare that restated or flex budget against the actuals, and then we've eliminated differences that are due to simply volume. After all, if we've operated at a higher level than our original budget assumptions in that fixed budget, of course the revenue will be higher. Of course the cost will be more. That's just the impact of volume. What we need to understand, ignore the volume, have we operated efficiently or not? And what's been the impact of management decisions? So, fixed and flex budgets. In that synoptic question, if they give you a report and you have to critique it, just check that they're actually comparing like for like. So, what else have we got here? Incremental, zero-based, and rolling or continuous budgets. Different approaches to actually creating a budget. An incremental budget, you should know the characteristics of one of those. A simple budget, taking a set of assumptions based on the current level of performance. If you like, the current level of performance is good enough. That's the basis for the budget for the next period. Let's just tinker with that. For example, let's just adjust for some basic growth, and let's just adjust for some basic price inflation. A budget is a costly thing to put together and to operate. It's a control system after all. And like any control system, you need to do your cost-benefit analysis to make sure that actually the cost is worth the benefit. So an incremental budget, a simple process taking the current position as the basis for the budget for the next period, is going to be relatively less costly than other methods. But is it good enough? Is an incremental budget not basically saying, well, what we do now is good enough? And how many of us can say that? I certainly can't. I can always improve on what I currently do. And that's the problem with an incremental budget. We're assuming that the current levels of inefficiency, the current levels of wastage are good enough to roll into the next period. We shouldn't be thinking that, should we? So what's an alternative? Take the opposite approach. Go for a zero-based budget. Accept nothing. Start, if you like, with a blank sheet of paper and prioritize everything you do. You then build the budget up pound for pound. You're scrutinizing every activity you do. It's going to take more time, isn't it? And therefore, it's going to cost more money. But is it beneficial to the business in terms of improving efficiency, reducing wastage? Downside, apart from the cost, is there a chance that you might take a bit of a short-term approach? Is there a chance that you might see something in the current budget, if you like, and you sort of doubt that that will be needed in the next 12 months? But is it there for a longer-term benefit for the business? For example, it's very easy to save some money to cut the training costs. But of course, is that short-sighted? Because keeping your staff trained is very important for your customer service and your quality. And reducing those costs could be detrimental to the future sustainability of the business. So, what about the rolling budget approach instead? Now, I said when you create a budget, you have to take a set of assumptions. Now, if you're in a fast-moving industry, the assumptions you make today could be very different to the reality of tomorrow. One of the businesses I used to work at, just to give you an idea of how a budget process works, we produce budgets for a calendar year. That was our financial year. But when did we start creating the budget for the next calendar year? Probably back in the summer, July or August. At that time, we have to take a set of assumptions about what life is going to be like the following calendar year. Now, of course, by the time you get to the end of that calendar year, life could be very different to that you've assumed. So the budget could easily be out of date. So the idea of a rolling budget is to accept that you need a plan going forward, base it on the set of assumptions today, but fully expect that after a certain period, you should revisit that budget, see whether the environment has changed, and therefore you need to update your assumptions. So what do you do then? Let's say a quarter into our budget period, we test the environment. We understand that the environment has changed. Our assumptions are out of date. What's the point of evaluating our performance against an out of date budget? What's the point of basing our decisions on out of date assumptions? None at all. It's not going to add any value to the business. So revise your assumptions, restate the budget, and roll a budget out for another 12-month period. Let's have a look at some of those other bubbles then that are left. Top down or bottom up? Who's involved in putting the budget together in the first place? Either end of a spectrum. The reality is somewhere in the middle. But a top-down approach basically means that senior managers create the budget themselves. They then roll it out and dictate it to the managers of their business. Now, there's advantages of that and there's disadvantages of that. Senior managers, after all, really ought to know the direction that the business is going in. They should understand the overall objectives of the business, and they certainly should understand, the financial position of that business and what it can afford. But senior managers are also distant from the shop floor, if you like. They don't understand the mechanics of the processes that are needed to deliver the products and services of the business. They're therefore likely to set very tight budgets. They have this ideal expectation that there will be no wastage and maximum efficiency. Now, it's a nice ideal, but it's not an attainable ideal. Therefore, if those budgets are set too tight using ideal standards, well, managers that are forced to work with these budgets are never going to achieve those budgets. They're always going to overspend, or they're not going to reach their revenue targets. Therefore, the motivational aspect described in Prime is going to be lost. The budget isn't going to motivate at all. And indeed, managers might buy out of the whole process. So, to get rid of some of those problems, do you turn the whole budget process on its head and leave your junior staff to put the budget together? Do they necessarily understand where the business needs to go? Do they have that oversight of the business? Probably not, but they do understand the operational difficulties, if you like. So the standards that are used to develop the budget are likely to be more realistic, more achievable. But are they? Will they set a budget that actually is just too easy to achieve? After all, these are the guys that basically their performance is going to be evaluated against their ability to meet that budget. So isn't there a chance that they'll pad the budget? They'll reduce their revenue targets. They'll increase the costs that they think that they're going to consume, basically. Increase the level of resources, if you like, that they need, even though they don't need them at all. That way, they'll meet their budget. Their self-interest is ticked, if you like, but that's not good for the business. The business is unnecessarily wasting money when it doesn't need it. So that integration part of budgetary control that I was explaining basically falls apart. Managers grabbing a bigger slice of the budget than they really need, depriving other areas of the resources they desperately need. The budget process is valueless to the business. So top down, bottom up, look at it. Motivational impacts. Look out for it in that synoptic question. So, standard cost. I've started to talk about standard costing. Standards are benchmarks, basically, that we can compare our performance against. They are, if you like, an upfront estimate of the resources we're going to need to perform an activity and the costs we think we're going to incur. Standards can be set from an ideal perspective, an attainable perspective, a current perspective, or a basic perspective. The ideal is the one that I was describing that those senior managers will take, with zero inefficiency, zero wastage. Ideal perhaps, but big impacts on motivation. Basic, out of date. The standard never gets updated, never gets changed. We're not stretching the business if we use basic standards. And it's pretty pointless for evaluation of performance as well, because surely we will always exceed that basic standard. Current. What we do currently is good enough. The incremental budget, if you like. And as I've already said, we can always improve upon that. So that leaves us clearly with attainable. The word itself suggests that that's the one to go for. An attainable budget should stretch our workforce. It should make our workforce strive to be more efficient and reduce costs and increase those sales. But at the same time, the staff should perceive that this is possible. It's something they can aspire to. They become motivated. Cost behaviour. What about that? Well, we need to understand our basic cost behaviour, something some of you would have learned back at level 2 in elements of costing, but certainly, if not then, at level 3 in costing. If we're going to put a budget together at different volumes of activity, we need to know which costs are going to change and which costs are going to stay the same. So those 4 basic cost behaviours. A variable cost. If we don't do the activity, we don't have the cost. As the activity increases, well, so the variable cost goes up in total. The assumption we make, unit by unit, that variable cost is identical. So if I were making tables, there's £10 of wood in a table. If I make another table, there's £10 of wood in the second table. The 2 tables together, 20 quid. A fixed cost. No matter what we do, the cost stays the same. The rent of our office, the obvious example, we can pack people into our office performing loads of activities, producing lots of products, lots of services. The rent cost is still the same until, of course, we exhaust the capacity of the office. A stepped cost, fixed up to a point. Then we realise we need to invest in more resources. So we need to take on another office because there's just too many staff in the existing one. And then finally, if you bolt a variable and a fixed cost together, you get a semi-variable or a mixed cost, the characteristics of both. One bubble left, the product life cycle. A bit of theory that raised its head in budgeting, it raised its head in decision and control. But what's it all about? Recognizing that some products, some services have a finite life. They go through stages of introduction, growth, maturity, and decline. But how do we associate that with budgeting? Well, because we need to understand what stage our products and services are at, because that has big implications for how many we're selling. At the introduction stage, well, it depends on the level of competition in the market, but relatively, we're selling less of the product. As we go through growth, hopefully, we're selling loads of this stuff and our volumes are steeply increasing, which has effects on how we price our products and services and also the unit costs. All of these bits of knowledge, which were within the budgeting syllabus, you should be taking into that synoptic exam. In the end, the synoptic exam is likely to present you with a budget that's been produced, maybe a budget report comparing budget to actual. There'll be a background scenario telling you maybe who's behind the budget. Also, there'll be information about where the assumptions from that budget have actually come from. Your job, tell the examiner what you think about that budget. Give an opinion. Is it going to work for the business or not? So, as a demonstration, I'd like to take you to the AAT Sample Assessment 1 and Task 1.2, a typical maybe budget question. And let's have a look at the sort of things that we should be questioning, the sort of things that are going down on our answer plan, the sort of things that maybe will just impress that examiner on the day. So here we go. Task 2, Sample Assessment 1. We've got a company called SL Products. It's acquired a controlling interest in a small manufacturing business called Merville Limited. Unaudited accounts for Merville's financial year end, December X2, have been prepared and they're shown for us. An operating budget has been drafted for approval to be put in front of the directors of SL Products. We're also told that the administration costs for X2 include a provision of $21,000 for a profit relating to a management bonus payable to the directors of Merville. Now, it's the directors of Merville that have put this budget together. Interesting thing in the first place. Remember, top down, bottom up? Let's start to think what their interests are behind this budget. Now, the easy mistake to make here is to think, well, they're directors, they're senior managers. I know this stuff. It's top-down budgeting. And off you trot with senior managers don't understand operational needs, etc. But actually, if you think about the scenario, this might be more bottom-up than top-down. Because although they're senior managers of the subsidiary who are trying to impress their new bosses. So what is their motivation behind the budget? Something that this question actually is asking you about in the final part, but I'll come to that shortly. Now, we're given information on the budget system. So if I just scroll down to bring up the rest of the question, we're then given some assumptions. We're basically told that there's been substantial sales growth achieved in the current year, basically. And they've introduced more than a dozen innovative new products. The key features of the products, we're told, are patented and protected from direct competition, and that our subsidiary Merville has a solid customer base. We're also told that with the new parent company, there's going to be a new sales channel and promotion in that parent's catalogue. 50 new products in the catalogue at all stages of the product life cycle. And more exciting new products are being planned. Here's the catch. The directors of Merville don't feel it's realistic to try to calculate sales revenue and costs at product level. I wonder why that is. However, they're confident that they will achieve the budgeted 10% growth in volume. They've not assumed any increase in selling prices because they say it's difficult to achieve with high-tech products. And finally, in addition to the 10% volume growth, they've allowed 2.5% for cost increases in line with expected inflation. So there's the scenario. The examiner doesn't write things just for the sake. There's clues in that scenario that the examiner is expecting you to pick up in your answer. So what are we asked to do? 3 things, basically, for 15 marks. Firstly, examine the assumptions and the calculations in the proposed budget, identifying any weaknesses. 5 marks. Secondly, explain how costs and profitability should be managed in an organisation that manufactures multiple products. 5 marks. And finally, Assess how well the budget would motivate managers to create sustainable and profitable growth. 5 marks. So, let's start with part A. Examining the planning assumptions and calculations. Growth of 10%. Where's that come from? This is what you're expected to ask. What do we know about their growth in previous years? What about the life cycle? We already know that Merville haven't bothered to put budgets together for their individual products, but don't forget they've got about 50 of them in that catalogue. And we're told that they're at all stages of the life cycle. Some have just been launched in the previous year. Aren't they going to be going through substantial growth? And what about the implications of now having extra promotion through the larger parent company? What about the exciting new products that are being launched with patent protection against them? No competition. Sky's the limit, surely. Should we really be setting our expectations at what might be low volumes? But we have no idea. We have no comparator. Tell the examiner that. It's got to be worth some marks. So, what has growth been like? Was it 10% the year before? What's the competition actually doing? Food for thought. How have the cost budgets been calculated? What about the cost behaviour? Look at the calculations behind that budget. If you get your calculator out, looking at the current year, and inflate basically by 12.5%, the 10% volume and the 2.5% for cost, you'll see that all those cost budgets work out exactly. Cost behaviour. You're telling me that every single cost is variable? Surely there's loads of overheads in there. Some of those costs should be fixed. But again, what do we know about the life cycle? As you start to produce more products, surely you should become more efficient. Surely you should start to get discounts because of higher levels of operation, etc. There is no drive to try and reduce the costs of this business. There is no drive to try and improve the efficiency of this business. And just going back to revenue, why haven't they assumed increases in prices? Surely if all our products are protected and there's no competition, we could charge even more. Should our business not be striving for continual improvement? Is this budget really going to stretch us? Now, surely if you're going to control the business effectively, you need budgets at product level. But hang on a minute, there's another part to this question. What I don't want to do is repeat myself. So I don't know if you do this and you've done this up to now with written questions, but don't think that you need to suddenly start beavering away on your keyboard from the first second you see this question. Give yourself time to think. Grab that piece of rough paper that the invigilator gives you. Think the whole question through. Jot down the ideas you want to talk about. It structures a far better answer. It gets all those thoughts out that you want to talk about, and it makes sure that you don't duplicate answers in different parts of the question. It's good practice, and there is time for you to do it. Here's a question. There's a management bonus stuck in one of those admin overheads. That management bonus hasn't been approved, but actually it's been used as the basis for next year's budget as well. Now, I don't know about you, but I'm not too sure a bonus should be in a budget. Surely the bonus is based on the management performance itself and therefore maybe should come outside of the budget. Food for thought again. Motivation of the authors of the budget. I've already suggested that maybe this is a top-down theoretical approach. I'll come to that bit in a minute. But the whole point is for you to say something interesting and to challenge. Challenge the assumptions. Say whether you think this budget is going to be useful or not. So let's move on to the second part of this question. Management of costs and profitability in multi-product organizations. Well, surely this is where I'm basically going to say, why haven't you got budgets for your individual products? How do you know how profitable these individual products are? How can you control the processes behind producing these products? We should split that budget down, or rather, we should produce the budget at product level and then basically consolidate it all together. We need to understand, therefore, at product level, what stage of the life cycle the product is at. At its introduction stage, with patent protection behind it, prices should be high. Market skimming is a phrase that you might have come across in budgeting and decision and control, but certainly premium pricing. But then as you go through growth, well, you can keep the price high if there's no competition. If the competition comes in with some sort of substitute product, similar but not the same, then you might have to reduce your unit prices. What's happening to costs? As volumes increase, costs will be dropping, we hope, because of efficiencies of process, because of economies of scale. Later on, you go into maturity. Nothing going on with the volumes. They're not growing anymore. Prices are probably stable, as indeed are unit costs. And those products at the end of their life that are going into decline, well, maybe the prices are reducing to sell as much as we can. But with volumes dropping off, unit costs maybe, if anything, are just going to rise. At some point, we decide this is no longer profitable. Let's pull our resources from this product and invest them in the exciting new products that are going to replace them. Standards to benchmark performance. With our individual products, let's set standards that stretch the business. Not ideal, but attainable. We can benchmark, therefore, the resources that we're using and the costs of those resources. We can calculate variances to pinpoint what's going wrong with our processes. Why are we inefficient? How can we improve the situation? Or maybe we are just efficient. Understand that, and we can keep that current behavior going. How are overheads absorbed? Remember, simple traditional methods of absorption costing against activity-based costing. With multiple products, complex processes, surely you should have a more sophisticated way to absorb your overheads, to try and understand the true cost of your individual product so that you can decide then the appropriate price, whether the product is profitable at all, and maybe try and reduce those overheads. Variance calculation springs up. I've already mentioned those. I'm in front of myself. So, what about the final part of this question? Does that budget motivate, deliver sustainable and profitable growth? Okay, well, is it top down or bottom up? I think the theory would follow that it's bottom up. Although they're senior managers, they are senior managers of the subsidiary, and basically their motivation is surely to make themselves look good in the eyes of their new bosses. That's why they're reluctant maybe to set those stretching targets, because they're worried that they might not achieve them. If they don't achieve them, they're not going to get that quite large management bonus after all. So the budget isn't stretching. It's not adding value to the business. It's not sustainable for the future of the business, keeping the business on its toes, being more efficient, reducing costs. In fact, there's the potential in this budget for budgetary slack, the padding of the budget. The revenue targets are reduced, the cost targets are inflated. The benefit and the value of the budget is diminished. What type of budget is this then? It's an incremental budget. They've taken the current level, they've rolled it forward as the basis for the next period, with all its wastage and inefficiency, And all they've done is said, average growth 10%, whack the costs up by 2.5%. That's good enough. But is it really? So, the task 2, budgeting question. You need to start thinking like a manager. Show the examiner what you've learned so far. Take nothing for granted. Is that budget good enough? Thank you. I hope you found that useful. I'm now going to hand you back to AAT, who would like to talk to you about MAAT status.
Thanks, Clive, and a big thank you to Peak Accountancy Training. I hope everyone watching found that session useful. Remember, you can re-watch the session to help your revision after the stream. Just go to facebook.com/YourAAT/videos. Now, as Clive just alluded to, I'd like to talk to you about MAT status. Because if you're studying for your professional synoptic assessment, it means that you're almost finished one part of your AAT journey and are ready for the next step. After completing the Professional Diploma in Accounting, you're eligible to apply for full AAT membership or MAT status. This gives you your designatory letters, MAAT, the letters that help you stand out from the crowd to employers and show the world that you have the skills and expertise to get ahead. So what is professional membership? Professional membership is your next step on the career ladder and gives you access to a wide range of support and resources that will support you throughout every stage of your career. Things like Excel e-learning modules, free webinars covering all of the latest industry hot topics, and career support such as CV writing tips and interview guidance that could clinch you that dream role. On top of that, you'll be able to use your designatory letters showing your current or potential employers that you've got the skills and knowledge to excel. And lastly, as our research shows, professional members earn more, meaning gaining your MAT status can grow your earning potential. Take a look at aat.org.uk/professional for more information and a helpful video guide taking you through all of your options. Did you know that you can start applying now? You might not know, but if you're studying your professional diploma in accounting, you can start your MAT application now, meaning that as soon as you pass, you can move to your MAT status straight away and start using your member benefits, and start using your designatory letters as soon as possible. One of the first steps in applying will be to submit your work experience. For more information on how to do this, watch our step-by-step guide in episode 2 of AAT Xtra, which you can find in the videos section of our Facebook page. If you find that you haven't got enough work experience to apply for your MAT status just yet, maybe think about taking up AAT bookkeeping membership or AATQB in the meantime. Gaining your AATQB designatory letters can help you to stand out to employers and help you gain what you need to get your MAT status. And if you're taking your professional diploma in accounting exams, that means you're already eligible to apply. Visit aat.org.uk/professional for more information or log in to your My AAT dashboard and start your application today.